Mindset. Thank goodness it's Friday. Happy to be here, guys. Really happy to do this live. Want to go over a couple things before I really get started. The first thing I want to talk about is we reached a huge milestone on the channel. We reached 100,000 subscribers. I wanted to thank each and every one of you from the bottom of my heart for hitting that milestone. Now, when I found that out, you guys, I had just got out of doing a medical procedure, so my head was all over the place, and I really still don't know how to respond to that. And the reason is, guys, is I want you to understand I'm not after the cloud. I'm not after these plaques. The real definition of someone that is a content creator that is effectively helping people is it's not the number of subscribers. It's how many people am I helping? How many people are growing from watching my videos? And so that's why it's kind of like, the 100,000 subscribers is not really a big deal to me. Because what is a big deal is that I see you guys learning and I see you guys understanding real estate. I see you guys working your purchasing power, your credit, your income, your assets, obviously doing subdivision analysis. And that's really my testimony. That's how I know, that's how I gauge myself, you guys. But I will make an announcement on the 100,000. I don't have the words yet. And I just had that medical procedure, so my head's still a little foggy. Now, in addition to that, and I hope you guys are proud of me. I'm a little proud of myself. I don't want to pat myself on the back, but the video that took us to 100,000 subscribers was the video that I did with Joe, who's a real estate or housing market bull. And I got to tell you guys, I was a little bit disappointed. There was a certain amount of people that thought it was a debate, and they were responding like, Travis, he ate you alive, da 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 da. And I'm like, you guys, it was an interview with a bull. I wanted him to sing. I wanted him to share with us his insights. I wanted to be respectful and make him comfortable. And obviously I asked questions that kind of surrounded my own personal thoughts. But when I invite someone to my channel, it's I don't want to debate you guys. I want them to sit there and I want them to communicate what it is they're thinking is going on with the housing market. And again, I hope you guys saw that. Not everyone did. I was a little bit disappointed. It was not a debate. Sometimes I feel like you guys want us to kill each other and blood and all that, but it wasn't a debate. Now having said that, and I prefer not to debate, usually debating you guys is just kind of like a, little clout match, if you will. But in the spirit of that, you guys, I'm actually bringing on let's see here, I'm bringing on Logan. Okay, so Logan's coming on the channel today at 9 a.m. Central Time, and we're actually going to have a debate. We're going to go into projections on mortgage interest rates, home prices, and inventory. So Logan is coming on, you guys, and Logan is the lead analyst for Housing Wire and a financial writer covering the U.S. economy with a specialization in the housing market. So I'm going to give you guys that. But just again, to be clear, as far as Joe, you guys, I wasn't beating him up. I came at him with about 20% of what I had. So just to clear that up. But there will be some sort of spirited debate on this live. Again, I'm proud of myself. First live back, 100,000 subscribers. And, I hope I'm showing you guys that I care about you guys enough not to keep us stuck in an echo chamber. I hope you guys understand that me doing that, getting uncomfortable, bringing these people on my channel is because I love you and because I want you guys to get sharper. Not all markets are the same. Not all situations are the same. And so the more that we can respectfully communicate with each other, the better we can all grow. But we have to kind of we keep our guard up, but stop swinging at me, you guys, okay? I want you guys to learn what they're saying. And Joe, if we really look at what Joe did, he gave us the blueprint on what the bulls are saying. Personally, I thought that was incredibly important. And you guys, again, I maybe agreed with 20% of what he was saying, but I found it very, very helpful. And I even got criticism like, Travis, you called him your friend. I mean, Joe, before we started that video, y'all, the guy helped me for 20 minutes. He's like, Travis, how you growing your community? Here's what you could do to help more people. And so, again, I hope you guys understand that. Really looking forward to this video. I'm going to get started, you guys. We're going to do a mortgage update first before we get started on talking to Logan. So I got about 10 minutes before he's supposed to come on here, but let me show you guys real quick. We're going to get started on, like I said, the mortgage report. So where we're going to start, you guys, here is the 10-year Treasury. Now, here's the 10-year. This is tracking mortgage rates. This is actually really, it's high. It's a little bit lower than it was. It's close to 4.5%. And what you guys are seeing here is essentially payment shock. We have payment shock phenomena going on around the nation. And this type of payment shock is not only affecting recent homeowners, again, almost every single recent homeowner post quantitative tightening, it's also affecting future homeowners, it's affecting renters. And also, you guys, don't forget, this is the inflation, what we have going on. The payment shock is also affecting homeowners that purchased prior to quantitative tightening. And the payment shock that they're experiencing is, skyrocketing insurance, skyrocketing property taxes, and new debt, right? New debt like doing a refinance, cash out, HELOC, maybe a new auto loan. But they're also experiencing payment shock. Payment shock is happening around the nation. I think you guys would agree with me on that. I mean, we have all the data that supports that. And so right now, you guys, this is kind of sitting at, we're stuck right here. This is good. We're basically sitting at, 4.5%. Now that's going to kick up obviously the mortgage rates. I'll show you guys right here. That's going to kick up the mortgage rates too. And you guys, is my audio okay? Hopefully my audio is okay. Anyways. So this is going to kick this up to 7.17%. So we're still elevated. We're still sitting in the 7%. Now, this was the good thing about talking to Logan about my projections for 2024 is I've already made them with Jason Walter. I've already come up with my projections. I went back and listened to that video, and I'm going to stick with what I said back in December with Jason Walter, and that's what we'll talk to Logan about. So far, it's been pretty accurate with my projections, and again, we'll go over that. But right now, you guys are sitting at 7.17%. Some things that I want to make clear here is generally the interest rate is lower with the thank you, Omaha, I appreciate that. The 30-year fixed rate is usually the lowest rate. Okay, again, just want to make that point to equip you so you guys can kind of figure out what makes the most sense for you. But right now, FHA is actually sitting at 6.7%. And, in my opinion, guys, talking about FHA, that's where we're seeing the lack of credit tightening. I've seen credit loosening with FHA in the form of MIP, mortgage insurance premium, what you have to pay for mortgage insurance. I've seen it go down. It's only 0.55 right now for one thing. So I don't see the credit tightening except for the payment shock. The credit tightening is the higher interest rates and the higher prices. So we still see credit tightening, but in an unaffordability way, not really a lending standard way. And you guys will take note as well that the 30-year is slightly lower than the VA as well, 30-year. And today it's matching 15-year. But a lot of times, you guys, the 30-year FHA mortgage is under the 15-year fixed, okay? So that's what's going on with mortgage rates right here. Now, again, if you've been listening to me, you should be shopping your mortgage rate, right? You should be shopping with a broker or a direct lender, see who's offering you the best deal. And just my opinion, right? I'm not a financial advisor, but if you have been listening to me, you should not, each and every one of you should not be getting these interest rates that you see here. You should be getting interest rates that are much lower because you have great credit, your debt to income ratio is low, you have a down payment. And I would say, guys, that you should probably be getting an interest rate about 50 basis points or a half a point lower than what you see here on the screen. Okay, so just keep that in mind. When you're trying to figure out what to do. Now, let's move on, you guys, to See Me Fed Watch, okay? So what y'all are looking at here is basically the market's expectation on what's going to happen next with interest rates. And I want to point out this real quick. This is very, very exciting, okay? And I've been waiting for this. This is insane, you guys, okay? Because, again, we have so much inflation still in the system. There's an overwhelming amount of inflation. What you're looking at on the screen is the first time, and I don't know how long, that they are now very slightly pricing in a rate increase. You can see it right here, 1.1% likelihood. Again, the market is pricing in a 1.1% likelihood of an additional rate increase. And you guys, because real income has not been keeping up with the price growth, that really leaves us to, okay, well, prices have to come down. Okay. If interest rates are going up, income is not going up, not matching inflation, then it leaves prices, right? The problem is, again, some markets super tight still, some markets aren't, very confusing, and we still need more time to go on. But how crazy is that, you guys? We finally have that being priced in at only 1.1. Now let's go to December, and let's see how, if at all, the market has shifted. This is so crazy, you guys. So again, going to December, you can see they're still pricing in December, the very end of the year, potential, it's very, very unlikely according to the market, but a potential rate increase of 0.2%. That's insane. But overall, you guys, the market's right here at 41.6%. So the market overall is thinking a quarter basis point cut. Okay, with a 31.8% likelihood of a total of 50 basis point rate cut. So, again, we can't really count on the market. This is always over optimistic. This is always changing, but it is very interesting to at least see the changes in the market. Obviously, when the Fed speaks, or when Jerome Powell speaks, it affects the market. So yesterday was a lot of hawkishness, and again, that's why I believe that we're seeing the market kind of like, are they going to increase rates? Like, we hope not, but are they going to do it? Are they? Right? So you guys see that right there. Now let's go real quick to the amortization schedule real quick. And then hopefully Logan will be here and we can start talking about some projections and kind of see where, what his thoughts are on that type of stuff. But here's the amortization schedule. This is at an average loan amount of $324,000. This is a 30-year term, and this is 7.17% interest. Okay, so this is today's average conventional rate right here. And again, you guys, I just really want you guys to understand how important it is to combat and fight your amortization schedule. Amortization schedules is almost worse debt than credit cards. It's not worse than credit cards. I didn't say it was. I said it was almost worse debt than credit card debt because, a lot of people will refinance and they will just start this over again and they will just keep eating up their equity and essentially be underwater. Because remember, you guys, it costs money to sell your property. So when we look at the amortization schedule, you have to understand that just the interest, not even counting what you pay back in principal, your interest is $465,000. Your interest is over 100%. Even though it says 7.17%, the way these amortization schedules work, again, you guys, it's front loaded with interest. And so if you really want to pay this sucker down and like beat the banks here, you got to make extra payments towards principal or just make a lump sum. If you made a lump sum of about $18,000 to $19,000 down on your principal, you guys save 5 years. At least, you guys save 5 years. You guys save over $100,000 in equity. It's a very good idea. Now, as far as making extra payments, let's see right here. All right, you guys. And I forgot to say good morning. Oh my gosh. Yes, that's true. Johnny, I forgot to say good morning. I feel horrible. Oh my, I'm so sorry, guys. Give me an extra payment here. Give me a number right here and we'll see how much time it takes off. Give me how much extra payment. So let's figure out, how much do we want to pay in extra payments to combat the amortization, to combat the loan? What should we do? An extra $500, $50, $60, $1,000? What do you guys think? Give me a comment below. Okay, we got Nikki first up here at $750. So let's see what adding $750. So again, you get with your spouse, you can somehow afford making an extra $750,000 payment towards your principal each month. Let's calculate this, guys. Okay, so again, $750 extra towards principal turns your loan into a 15-year loan. So if you want a 15-year loan without being locked into the higher payment, do y'all see some of the strategies you could do? An extra $750. That's it. $750 gets you that 15 years, 1 month, and you save $259,000. That's a lot of money, you guys. Again, my point is, obviously, pay that sucker down. Pay that sucker down, beat the banks, and put yourself in a higher level, you guys. It's about education. Just pay attention to the amortization schedule. Now, let's see here. I think Logan just joined us. There you are, Logan. I see you, buddy. I see you. Let me get him on here real quick. Boom. Logan, fixing your hair there, buddy? Can you hear me?
Hear me?
I can't. Were you fixing your hair?
I can't hear you.
You can't hear me? I can hear you. I can hear you.
Hold on. Let me.
I've got a couple people asking who's Logan. So Logan, you guys, Logan is the lead analyst for Housing Wire and a financial writer that's covering the U.S. economy and specializing in the housing market. And Logan's pretty bullish on prices. So can you hear me yet, Logan? I don't think you can hear me yet.
Okay. Can you? Okay.
You guys hear us now?
Video.
I can hear Logan. Can you guys give us an audio check on the comments here? I don't know what's going on here. We can hear you both. Okay, good. Good. Well, hopefully we'll get him on here. I know. Jeff, be respectful to both your guests. Yes. Conversation is what we need in America. Exactly.
Let me try this.
We're waiting. Okay, I think he's going to come back. I mean, you guys, I'm trying. Yeah, I can't. And for the sake of transparency, I'm going to tell you exactly how this came to play. I think it's pretty. It's not me, man. It's an audio thing. It's not my mic settings. I mean, it's not. I've been doing this long enough, Johnny. It's not. And we could hear Logan. Logan couldn't hear us as the issue, so he's going to try to come back in. But again, you guys, and I don't want to put words in his mouth. I'll cover this when he gets on. But we're going to kind of debate, okay? Because you guys, hey, Travis lost to Joe. No, you guys, that's respectful. So we're going to debate projections for 2024 and for 2025 as it pertains to prices, inventory, and mortgage rates. And I'm going to, again, for the sake of time, I mean, we're losing time here. I was really bummed about that. But for the sake of time, you guys, we're going to stay in that box. I'm going to kind of just keep us right there so we don't just throw up information onto you. I'm not sure where Logan is. He dropped out. So, we're going to sit tight for a second and let me throw up some comments. Why don't you guys throw up some comments real quick as we're waiting for Logan to kind of get his, his technicalities together here. Boom, boom, boom. Travis, like the memory cards, just like the memory. I don't know what you mean, man. What are you talking about? So, Logan, they could hear you. It's not respectfully. Yes, respectful. I'm going to tell you guys, I really appreciate you. I'm really looking forward to talking to him, to be honest, as long as he can get here. But let me go back real quick, Christy. Good morning. Sorry, I didn't say that before. Trey, this is my boy. I love Trey. Honestly, you guys, when I'm talking to you, a lot of times like this camera right here, I'm talking to Trey. And Trey's one of the guys that has listened to what I said. Trey used beef jerky, the beef jerky method. Remember, you guys, I lost everything. Trey's using the beef jerky method, okay, to better his situation. So Trey, love you, brother. Vovel's there. Good morning, brother. Good morning. There's my buddy, Jeff. Jeff and I talked all the time. Mav, Night, Cry. There's Jason Walther. What's up, Jason Walther? Obviously, Johnny. Okay, let's see. I think Logan's back. Let's see here. Logan.
Yes, I can hear you now.
Man? Can you hear me?
Yes.
Okay, your hair's looking great. How's mine?
Parted on the side pretty good.
Just not over here. All right, brother. How? Well, I appreciate you being here. You ready to go?
Yes, absolutely.
Okay, good. Now, just for the sake of transparency, Logan, I want to kind of tell, I want to tell you and I want to tell my viewers kind of where I'm at, why we're doing this. And the first thing I want to disclose is, and I told you this as well. This is as crazy as this sounds. Okay. This is my very first debate. Okay. This is my very first debate in my life. So am I at a disadvantage? I don't know. I'm wearing a t-shirt, right? This is the very first debate I've ever had in my life, Logan. And I just wanted to let you know just real quick before we get started, I am so honored that my first debate per se would be with someone of your caliber, as far as your influence, as far as like your data analytics. So I'm super flattered. And also, the other thing, Logan, again, just for transparency, I've been a housing market bull my entire life. So I feel like I'm a new bear. I've only been bearish in the housing market for like 2 years. So I'm like a panda bear, And I got to tell you, Logan,
panda bears can be tough at times.
I saw Kung Fu Panda. I've seen Kung Fu Panda, man. I've watched that show. I have 4 children, but my point is, man, it really sucks being bearish. What I've noticed is like my point in being bearish is like the caution. Let's talk about wedge. Let's talk about cash flow, but the hate that I've been getting from my peers is like, it's shocking to me. It's like, all I'm trying to do is tell people to be cautious. But regardless, man, I appreciate you being here. And, I want to be,
what the funny thing about that conversation is that I had put the housing market in a recession, the existing home sales market, on June 5th, 2022. And I've never taken that off. And I think the economics of housing is a little bit different than how I would say maybe investors look at the housing market. That equilibrium is different. And that's something that my work over the years is more on the economic side of this rather than just the focus on the price side. Because a lot of people say that, well, housing isn't in a recession until existing home prices fall. And that's not true, because, the history of nominal home prices declining since 1942 is not a lot, but we've had many housing recessions post World War II. So I think the economics of housing and how pricing goes for the existing home sales market are kind of two different things.
Yeah, Logan, that's and that's where I get a lot of the misunderstanding as well. It's just like when we're talking to investors, we're talking to people with usually a whole bunch of money per se. They're a lot better positioned with purchasing power and things like that. But on my channel, I'm talking to the consumers. I'm talking to the people at the very bottom that I believe need the most amount of help. And to be transparent with you, man, and I hope to prove otherwise, but a lot of people on my channel, view you as just having a paid narrative that you're only going to say housing value is going to go up. They see you as belittling people. And I hope, Logan, because at first I didn't even know who you were, right? I listened to a couple of videos. I'm like, this is a dude from Jersey Shores that, the price only go up. But when I started listening to you, I was like, first thing I thought, Logan, I was like, thank God he's not just a realtor. Like, thank God, man. At least you're talking about data. And so let me bring us here, man. Again, just for the sake of time, I'm going to put this up on the screen, Logan, and just tell me if you can see this. Now, Logan, this is going to lead us into price. Now, for the viewers, Logan and I, again, and just confirm this, Logan, decided to kind of debate our projections for 2024 and 2025 as it pertains to price growth or not, right? Inventory and mortgage rates. Is that correct, Logan?
Yes.
Okay, awesome, brother. And if it's okay, I want to start here again. I'm gonna show the viewers that you're more than those things. Okay, and this is a kind of common ground, and this is going to lead us into prices. Now, what we're looking at here, don't look at the graph. That graph is the national payment to income ratio. Hopefully, we'll get back there, Logan, and we can talk about payment shock. And I think you've been in loans, so you know what payment shock is. But kind of just sticking to the 30-year average affordability, this is saying under current market conditions, in order to get things back to affordability levels, that we would need a decline in interest rates of about 3.5%. In addition to that, we would need a 49% rise in median incomes and or a 33% decline in prices. So Logan, to start us out here, can you kind of give me your thoughts on that? And is prices going down something that you've eliminated?
Well, if you actually look at that chart, back in the early 1980s, it was actually worse. And we had a lot more active listings in the early 1980s than we have currently today. And during those recessionary period in the 80s, home prices actually rose because the supply and demand equilibrium was that we were working from such a high level of interest rates back then that when rates started to fall, we already saw the home sales back then went from 2 million to 4 million and then collapsed to about 2 million. And then home sales started to rise with higher inventory. So prices rose back then for a different reason. Here in 2024, I probably have one of the lower home price growths because I'm not a Fed pivot person. So nominal 2.3% national home price growth, which means real home prices will be negative this year. So what we have now is we still have near 5 million total home sales in 2024. My argument has been post 1996 is that it's really rare in America to get existing home sales below 4 million. So the housing structural dynamics changed on November 9th, 2022. If home sales kept on crashing, then the forward-looking indicators of housing would kept on going negative for pricing. This is why even in 2023, I had price forecasts to be negative as long as the forward-looking indicators stayed lower and rates didn't go below 5.875%. But what happened in November of 2022 is that the forward-looking indicators started to go positive for 12 weeks. And when I talk about forward-looking indicators, this is our 10-year yield, purchase application data, active listings, new listings data. All those things actually were favorable for prices at that point. By the time it really hits the existing home sales and case shillers and everything, it's going to be 4, 5, 6 months old. So in the end of 2022, when the forward indicators change, then we're going back to what we have earlier in the cycle. Too many people chasing too few homes, that's favorable for pricing in 2023. And then similar in 2024. home sales stopped crashing. We can't really break under 4 million yet. Even with home prices escalating, even with 6 to 8% mortgage rates, there's a natural core 4 million home buyer. And it's even more egregious now that we have over 158 million people working. And that's how low home sales are. So my argument is that we have the lowest levels of home sales ever recorded in history. But also with that variable, we have active inventory still near all-time lows. And the key is the new listings data is still trending 4 years at the lowest levels ever. So how we show people with our data line is that new listings is very seasonal. The last 4 years has been averaging between 30 to 90,000 a week, going up to the seasonal peak in June and July. Back in 2008 to 2012, this data line was running at 250 to 400,000 per week.
Right. And Logan, and I want to get there, brother. I want to get to the inventory, but really, again, going back to this, and I understand the national, and I want to come to national payment to income ratio, but really my question is would you agree with those fundamentals? In order to get us back to the 30-year historical averages, we would need, a combination of those three things happening. Would you agree with that?
Yeah, and that's going to be extremely difficult anytime soon. So
okay.
It would actually have to take an economic recession to get mortgage rates to even go low enough to even have that conversation at that point. So I'm assuming that affordability is going to be terrible for a long time.
Okay.
I don't have any of those, all those variables working together. You would need at least 3.7 years of nominal wage growth to be about 4.2 to 4.5. And then in that period of time, rates would have to fall to offset the affordability curve. But that's something that has to take a while to work. So I'm just assuming that we keep that 4 million base level stuck for a while.
Okay.
And to get above 4.72 million on a monthly sales, you're going to need rates to get, below 6.
Okay. And that's possible. I mean, but so we could agree that, rates are probably not going to go down to 3.5%. Is that correct?
That would
anytime soon.
That would take a recession. Yeah. So
right.
I'm just assuming sales are going to be low for a while.
Okay. And then, and also, you're like you were saying, and again, I appreciate you being here. You don't really see any type of price decline. And so you're not seeing price as far as this historical average, you don't see the price decline. We both agree rates won't go down to the 3.5, which leads us back to income. Now, do you see in the next 3 years, 4 years, however long you think it's going to take, do you see income rising 49%?
So this is where this discussion takes another fold. This indicator right here, if you don't tag it to a sales level, it kind of is somewhat misleading, because what we have in America is we have a lot of dual household incomes. So like how I explain is, how do we have 5 million total home sales existing in new home sales if affordability is this bad? Shouldn't it go down to like 2 million? And I would say that the dual household incomes in this decade are a little bit different, because ages 30 to 39 are massive. So when you put the dual household incomes together, that's a big reason why you still have near 5 million total home sales. If I had an affordability metric that drove the dual income home seller that is a buyer down to a lower level, then at this point, that affordability issue becomes even worse and worse. But if we're staying at the 4 million mark year after year after year, then the equilibrium of housing between supply and the buying power is a little bit different. At 6.5 million, you can see what happened. 2022 had the fastest and biggest crash in home sales ever. And this is year 3 of the lowest home sales ever recorded in history. So as long as the 4 million home buyer is here, we're just kind of stuck. So that affordability killed all the marginal home buyers. And we only see the marginal home buyers come back in for a little bit when rates fall 1%. So this is where that supply and demand equilibrium discussion becomes key.
But again, Logan, I mean, but do you see income going up, 49%? Do you not?
No, and it doesn't need to. And it didn't need to in the last 18 months, because if it actually created lower sales, then it becomes a supply and demand equilibrium problem. But for right now, we're still maintaining that 4 to 5 million total home sales mark. So we have to work off of that demand curve. And that's similar to what we've had, in the early 1980s, when affordability was terrible, but it started to get in slowly a little better, and home sales started to slowly rise. Something like that in like
Right.
what we saw in the 1980s would have to occur. And that took time. Like
Yeah.
I encourage people,
Yeah.
go look at existing home sales in the 1980s. It took time for that to work. So we are stuck here with these very low levels of sales. I don't see that changing materially unless rates fall in a bigger fashion and stay lower.
I guess my thing is, Logan, is just, I don't see how people can continue, to pay for this. And I think what you were saying is these days things are different. Like, there's more families, dual household income. And are you basically saying that, today, 2024, that families are in a better situation to purchase as far as
Yes,
qualifying?
and this is why our pending contracts data is actually positive year over year, slightly, not a lot. So I'm just working off of that 4 million base level. If I could find a model that breaks that for the first time post 1996, that would be materially big. Like here's one confusing thing I think people see. People see the purchase application data and it's still negative double digits year over year. So people assume that means home sales should be trending between 3.1 or 3.2 million. That's a trend survey. The pending contracts are still positive on a year-over-year basis. So that 4 million core, this is why I've always tried to teach this over the last 10 years. As long as that core buyer is there, you have that baseline demand. Anything above that would actually need affordability to get better. So you would need actually rates to go lower. And I'm not a lower rate person until the economic data gets weaker, and it has to stay weak enough to where
Yeah.
everything flows together. So I'm not a big home sales growth person.
Okay.
But that I
Okay.
hold that line for that existing home sales market 4 million. And then if you look at it in that contrast, the last 18 months makes a little bit more sense. And then the affordability metrics that are so poor, you could say, okay, well, we have all that, but this 4 million home buyer hasn't left yet.
It's interesting though, Logan, because, and let me throw up some data real quick. Let me throw this data up here. This is real median family income. So this isn't even household. I'm using family income because it's a higher income. Now, obviously, this goes to 2022, but actually, again, according to this data, this is real. Contrary to what you just said, real income has been going down for families. If you look here, can you see this okay, by the way?
Mm-hmm.
Okay, so if you look here, and this is Fred economic data, again, this is contrary to what you're saying. In 2019, it appears that the family income peaked at 97,970. Fast forward only to 2022, Logan, so we don't have 2023. We're at a disadvantage. That went down $92,750. And if I'm not mistaken, that's actually a decrease of, that's a decrease. So why are you saying that, family income's going up, and why is this data saying otherwise? Why is that?
Because
What's the
you're
discrepancy?
looking at the adjusted to inflation income, and
Right, real income.
I'm looking at the total incomes of home buyers. So the average
But
home buyer in
but Logan,
America,
isn't adjusted for inflation? I mean, we're in a battling inflation right now. Isn't
it
adjusted for
it
inflation a better
is
gauge?
it
So it's a
is,
better gauge.
but
Okay.
how do you have 5 million total home sales still? Because the dual household. So this is how I present this at events. I have a home buyer, the couple. That one couple, one person makes 90,000, the other makes 70. Okay, you're gonna have $160,000 of income. That blows that chart away. So the home buyer income, when people look at it, is actually much higher than the natural incomes out there. So this explains why total home sales are near 5 million. If that median income was decreasing and home sales were decreasing at this point, then it becomes a bigger issue. But even with rates at 7% this year, our pending contracts, everything is still holding that 4 million at bay. So the dual household income factor is actually much more higher for a home buyer, right? So you take
Right.
the 158 million people working, you take the home buyer of the median incomes, the dual household income overrides that data line. And that shows that two people's incomes are higher than that real median income data line. And that explains how we have 5 million total home sales still.
I mean, I would explain it fear of missing out. We had fear of missing out going on. We see it in the recent buyer's regret surveys. I mean, you could be right, right? But again, I look at it like those buyer remorse surveys are not good, Logan. They're not good. And I know it's only a limited scope. Okay. But anyway, this for the sake of time, okay, we've gone into those averages. Now let's go into the projections. All right. Now, good thing, Logan, is I've already did my projections. I'm going to stick to it. I did my projections in December of 2023 to 2024. Out of respect for you and our viewers, I went back and I listened to it again just to make sure, do I still agree with my projections? And so Can you talk about, starting off with prices? Can you tell us, and you alluded to it a little earlier, and I wrote it down, but I don't know if the viewers heard, but give us your projections for 2024 as it pertains to prices. And can you specify, what are we talking about prices? You are in the mortgage business. You know that median is a horrible way to come up with value. Value is determined by this, an appraisal, comparable data in a subdivision. That's really what we should be emphasizing. But tell us what value we're measuring. Median, new.
So I hate median sales price. I think it's useless.
Yeah,
The Case-Shiller, Zillow, FHFA, Fannie Mae, for those rolling averages are more efficient. Now, so far, I'm wrong with my price forecast. It's a little bit prices are growing a little bit stronger, but I would argue that toward the second half of the year, I'll probably be a little bit more correct than the first few months. The first few months is showing stronger home price growth. The inventory channel started to increase just a little bit later this year than I expected. The new listings data is growing just a tad slower than I thought. But over the next 6 to 8 months, I think I'll be closer to my forecast of 2.3% nominal home price growth nationally, which means real home prices are negative. But as of right now, I'm probably going to be wrong. Right now, it's going to show a little bit stronger home price growth. But I do think over the next, or especially the second half of the year, that price growth should slow down and I get closer to that level than what we had earlier.
Okay. All right. What about 2025? So we got 2024.
I don't do forecasts until the end of the year because
okay, thank God.
I take all the variables in here because what happens now is economic data is so much more violent now than it used to be. In the previous decade was the weakest housing recovery ever. Everything was so slow. You might have had just 2 years that were somewhat interesting. And then post-COVID, everything changed. The data in itself is much more violent. The bond market is much more active than what it used to be. So at the end of each year for the last 14 years, I do a forecast, and then we have this live weekly tracker data that we track. We keep everyone on a par because what our data line is about months ahead of the NAR and a lot of other people. So we get to see turns. So we don't want to be incorrect if a turn happened. And so far early in the year, price growth was going a little bit stronger than I anticipated, but toward the second half of the year, it should slow down.
And that's prices based on median. Is that correct?
Just the rolling averages. Just what would Case-Shiller be? What would FHA be?
And this is for the viewers, Logan. One of the issues with median, and I don't want to put words in your mouth, so tell me if you agree. One of the issues is it's not how, for example, if you get a loan, collateral is appraised. You have to take comps in a subdivision. If you're just taking median zip code, you could potentially compare a crack house to a mansion. And so you got to go, hyper local. And I want to say now my projection, Logan, for prices. Sorry to interrupt you, brother. My projections for prices, and again, this is in December. It's a little bit hard because I'm following a recession, and honestly, I'm going to get killed by some of my peers, Logan. There's so much inflation in the system. Okay, first of all, from a deficit spending standpoint, okay, fine, guys, we hit a recession, but I'm talking about like a spiraling out of control, like unemployment. I don't see that happening till it could happen sooner, but the end of this year, at the soonest, man, because there's just so much money. And so what I've said on a nominal basis, not even adjusted for inflation, so I'm going nominal, I'm suspecting a minimum of 5%. So single digits, I suspect 5%. Again, because I don't think we're going to have that confirmed recession this year. I think that the bad stuff potentially starts happening, Logan, when we hit recession. But I also want to say this, here's what I'm basing this off, and I think that you would appreciate this. Now, I don't think, like you were saying, I don't think we're going to have that nominal growth. And if it does show it, I think it's going to show it because more $1 million houses are selling year over year. The lower end houses are not selling as many year over year. But this is a big thing right here, Logan. Price cuts. Right now, price cuts, this is Redfin, price cuts are at 6.4%. Now, you said in 2022, we had a period of deflation in the housing market. Prices went down. Big part of that was because the price cuts led to prices going down. And so I don't understand why you would say prices are going up when we have price cuts. Well, hold on one second. We have price cuts right now, 6.4%. Now, in 2022, that peaked to, and essentially what I'm saying is the price cuts are 2 months ahead from a percentage standpoint. It's 2 months ahead of 2022. Now, Logan, would you agree that price cuts are important to track?
So it is, but if you're looking at Redfin's model, if you actually add the Redfin's price increases on a year-over-year basis, it's actually showing prices growing with the price cuts rising. So I think their slope curve is a little bit different. What I would argue about 2022 is that 2022, the slope of the price cut curve was very fast. The slope of the price cut curve this year is slow. It's not as slow as 2022 or 2023 was, but their slope of the curve actually shows price cuts, but also prices increasing year over year. So
Right.
their model is just a tad bit different than ours. But if you look at Redfin's year over year price gains, it's actually showing
Yeah,
price
but
increases
Logan,
too.
wouldn't that, again, the price cuts, again, wouldn't that just further demonstrate that we can't use median? Because the price cuts are accelerating, and we know that the data from purchase applications and from sales transactions, we know the higher end of the median is selling, the lower end is not selling as much. Won't that actually complement that narrative as far as
So
median sales price being absolute, garbage? And that's just price cuts. I'm also basing it on, I'm trying to find it, dude. I hate Redfin, dude. I won't lie, man. Oh my God. Median days on market. Okay, so here's another, and this is, and I'm going on my projections. Here's another reason, days on market. Now, I think that you would agree that when days on market gets 30, that interesting things happen in the housing market. So not only do we have price cuts ahead of 2022 when we had deflation, we have that 2 months ahead. But if we compare the days on market to 2022, we are 4 months ahead on days on market. Days on market hit 30 about September of 2022 right here. So we have price cuts again, and I'm using 2022 as an example, Logan, because I think you acknowledged during this show that we did have deflation, right? And so again, price cuts 2 months ahead, days on market 4 months ahead, and the fact that we have more inventory shows me that demand is not keeping pace with supply, and that's why I say, 5 nominal, not real. And I appreciate you saying, you said decline real. Thank you. So that means that you're not just, but do you see my points here, Logan? Do you want to respond to that?
I would argue you can't use 2022 data now because 2022 data had the fastest and biggest home sale crash ever. So the slope of the price cut curve is faster. That's Redfin's data, but our weekly data actually shows that slope was extremely fast. The inventory channels actually grow very fast. The price cut percentages in the second half of the 2022 market, when home sales were crashing in a very big fashion, the products that were available on there actually needed price cuts to sell. But the new listings data started to go negative on a year-over-year basis in the second half of 2022. That set up 2023. So the marketplace now no longer has the biggest home sale crash ever recorded in history.
Right.
So
right.
the inventory price cut curve channels are slower. And that's kind of why Redfin's is still showing price gains. Our model is a little bit different, that the slope of the curve is actually growing, but it's not as fast as it was in 2022, because 2022 was an abnormal year. So
Right.
that's why I think
2022, but Logan, 2022 was abnormal. But my point is the price cuts is the DOM. It's matching it. And I don't think that we could say that we can't use 2022 data. I think 22 data is important because we did have prices go down in 2022. So I asked myself, as someone that likes to analyze data, why did prices go down in 2022? And if we look at you said it yourself, it's important to follow price cuts. I've heard you say that when DOM hits 30 days, it's important to watch that. Well, hold on, Logan. And so if that's important for you to watch, why, when I'm bringing this up now, talking about how I'm getting my projection, why is that no longer important to you?
Because the slope of the curve is slower. So that's why home prices went up in 2023. And so far this year, home prices are up month to month, every single month on the price curve. So if you look at Redfin's data, they kind of show that as well. I would argue that home sales were crashing in 2022, like massive. Like it was 3 years of home sale crashes into like 12 months. So the marketplace, the dynamic structural change, this is actually why
But
November of
real quick though, Logan, didn't we have 5 million sales in 2022?
we had 6.5 million existing home sales in January. It went all the way down to 4 million. That was the fastest crash in sales ever. We have
So
nothing.
I'm looking at the data here from this is the National Association of Realtors. I'll throw it up on the screen. It actually says, again, contrary to what you're saying, it's saying 2022 the sales volume was 5 million. Are you saying
No,
it was not? That's
if
not
you
correct.
if you look at the monthly sales prints in January, 6.5 million. At the end of the year was 4
Right,
million.
but I'm talking about the total. Again, this is the total for the year 2022. It's saying 5 million.
Yeah,
Is
that's the velocity of the monthly sales crash. Like it took 2005
okay?
for existing home sales to go from 7.2 million to 2008 to about a little bit under 4 million. Here, it literally happened in 1 year.
All
So the
right, all
monthly
right.
sales are different than what you're looking at, but the total sales, you have to remember the total sales are also what you see at existing and new home sales put together. But the monthly sales actually went from 6.5 million to the 4 million. If you do the dot plots of the monthly sales, you can see 2022 was the fastest crash ever. It's for us to replicate that, we would need 4 million to go down to like 2.4 million to replicate the same monthly sales decline prints that we had in 2020.
But
this is why I always tell people,
that's not the fastest crash, though. I mean, again, in 2006, we went from 6.4 to 5. That's a
I'm talking about monthly sale prints.
Oh, just the monthly. You're not.
Yeah, if you look
but
at
I was
the
talking about
monthly
the annual for the whole year.
sales prints, January was 6.5 million, and we got down to 4. The reason I say the 4 million number is because historically we don't really break underneath that in any big fashion. So if you look at the dots of every single sales print after or January of 2023, you could see that home sales actually stopped crashing, and they're actually growing on a year-over-year basis in a slight form. On a monthly,
except the GFC though. GFC, they crashed in the GFC.
They got all the way down to 3.77, but we also had a lot less
under
people
4
working back then.
Under 4. Oh my God! And I was one of those people, Logan. Did you know I got wrapped up in the GFC?
It took 3 years for that to happen. That's the thing, is that this took 12 months on the monthly basis. This is why it was this is part of the savagely unhealthy housing market theme that I've had, is that because of qualified mortgage laws, basically, literally anybody that puts their home on the market has to be pre-qualified to sell to buy, since 75 to 82% of sellers are buyers. So naturally, if you can't afford, you are not going to list your house, because the sell to rent model we don't have any data that becomes the majority. So when home prices escalated out of control after 2021, my affordability index broke. All it needed was the 10-year yield to get above 1.94%. And once that happened, it was over. So this is why
back to what you're saying, as far as qualifying, to your point, actually against your point, not for new home sales. New home sales, I don't know if you're still originating, but a lot of those buyers are forced to pay the tax certs from the title company. A lot of those people are being qualified based on dirt value, not dwelling. And again, because the certs from the builders, they're paying money on the dirt, not the dwelling. So they're not qualified for that sky. Again, that's a section of the market that's talking about new homes. But I would agree, as far as like back in the GFC, man, I mean, the regulations are different. We have to qualify, we have to verify people's income, and people can't just have a 0% down on every single loan. But let's go to the next.
That's exactly why the inventory data looked different back then. Like from 2000 to 2005, inventory was growing and sales were booming. So a lot of people forget that, but the monthly supply was under 5 months. But because the credit markets were different, anybody could sell their house to buy. So inventory actually go from 2 million active listings to 2.5 million. And then the whole thing broke after that point. So yeah, that's the thing that I think a lot of people, this is why I'm not a mortgage rate lockdown person. So we have natural sellers every single week for the last 18 months that have been selling their low mortgage rates to buy. It's just a very smaller portion of the marketplace compared to what we had back then. Back then, credit allowed everybody to do anything. Now you can't. You literally can't. So when affordability breaks, it breaks. There's no ifs.
I would say it's broken now. But let's go to the next thing, Logan. So basically, for the viewers again, Logan is 2.3 nominal growth. I'm a nominal decline of about 5. And we're just talking about 2024, Logan. Let's go into inventory. You may be surprised my inventory, debate here. So I'm excited to hear. But can I ask you, Logan, just kind of before we go into the inventory in your projections, do you consider, the consumer right now, like the family consumer, better off than 2019 or pre-COVID? Do you consider them better off?
Home buyers, yes.
So
Renters,
you
no.
so you consider
Renters,
home
absolutely not.
buyers right now
Yeah,
better off than 2019?
Homeowners now have an unbelievable advantage because of the nested equity they created. So that's the FICO score trends have been stable for 14 years there. But the nested equity positions that they have. So again, it goes back to what's the best hedge against inflation was a 30-year mortgage, your fixed debt cost, rising wages. So during an inflationary period, homeowners actually do better because their debt costs stay the same. So a renter doesn't have that advantage. So this is why you see in the credit data, younger household renters are already, credit card delinquencies, auto loan delinquencies. A lot of that is coming from the renter household. So homeowners versus renters, it's not even a competition, but renters definitely stressed.
For the consumer, though, overall, you're saying consumer-wise, they're not better off, or they are better off than pre-COVID?
Renters are not better off. Homeowners are.
If I can,
So
real quick,
let me split the two.
For the viewers. Let's talk about the homeowners just for the viewers comparing 2019, because I don't believe that the homeowners of 2019 are better off than now. I think they can't tap their equity. They have property taxes, but when we look at interest rates back in 2019. Okay, this is crazy, Logan. I didn't realize how low, but interest rates were 3.74% right now. Fast forward today, and I know you said current homeowners, but if you're a homeowner, you want to sell, you have 30 to 40% from an interest rate standpoint. You have 30, 40% less purchasing power. So on basically just interest rates alone, I don't see them better off. But also, this is crazy, Logan. When we look at the savings rate going in, again, end of 2019, savings rate was 6.4. Consumers on average, again, it's not differentiating the two, but consumers could save at double the rate. So I don't see how you could say, again, that they're stronger. And then in addition to that, just keep on going. This is for the viewers. According to the Fed, okay, this is news, came out this month, we have no more excess savings. So again, they were saving double the rate back then. We no longer have any, excess savings. And then I go back to the real median income. In 2019, real median income was going up. Okay, it went up. After 2019, it's going down. So from adjusted for inflation standpoint, they were making more money in 2019. And so again, I don't see how you could say stronger. And then when we look at delinquency rates, this is the last thing I promise to let you talk. I'm so sorry, Logan. I don't mean to, delinquency rate. I love you, brother. Thank you. And again, it was just one more time. Thank you for coming on, man. I hope I told you I was flattered. I don't know if I said that yet. And my hair's not better than yours, and my beard isn't either. I wish it was your beard. Anyway, so this is delinquency. The other thing is the delinquency rate back in 2019 for consumer credit cards, it was 2.62%. Right now, it's 3.16%. And I would like the viewers to look at the trajectory here, which again is, to me, it's demonstrating that the consumer is unhealthy. If they can't pay their bills, then the party's got to stop. And then again, you have the PE ratio. The PE ratio right now is, Logan, it's 7.68. 7.68. Okay, but one more thing, again, 2019. Okay, again, the PE ratio was 5.68. Right now, it's 7.64. So I guess it depends when you purchased. And the payment to income ratio, the form that I had right here, payment to income ratio was 20%. Now it's obviously it's much lower. It's much higher. It's 36.1. Now, I would say, though, as far as inventory, Logan, inventory was better in 2019. Inventory, we had 1.39 million units, and we had 3.9 months of supply in 2019. So I think we're pretty close there. And, the last thing that's really, really interesting is the unemployment rate. The unemployment rate was actually much lower, not much lower, but it was lower in 2019. Ending 2019, the unemployment was 3.6%. So unemployment's higher, savings is lower. So why are you saying that people are better off?
So I'm gonna show, this is the FICO scores of households in America that are homeowners all the way. This has actually never changed after 2010. When qualified mortgage came in, these homeowners have always went into the home buying process with a very good FICO score. So they have their fixed debt costs. And throughout, since 2010, all the way down to 2024, majority of these households have refinanced. So their mortgage payment as a percentage of disposable income are at all-time lows. So this is a historical phenomenon. Now, a lot of people see this FICO score boom and they think it's FICO score inflation. We just originated more loans as a country. So these are purchases and refinances. So because they have stayed in their homes longer, what's occurred is for the first time ever, from 1985 to 2007, people lived in their homes 5 to 7 years. From 2008 to 2024, that housing tenure has doubled, 11 to 13 years in some parts of the country, 15 to 18. I mean, I've lived in my home for 20 years. What's occurred is that 40% of all homeowners don't even have a mortgage. And the people that actually do have stayed in their homes longer. So their natural incomes have risen throughout the last 14 years. And during that 14-year period, the majority of the stock of homeowners have refinanced their debts to the lowest levels ever recorded in history. So the homeowner that actually has to sell to actually buy another property to take that increase is probably doing really well that they can take that kind of hit. And this is why the dual household income factor over a 14-year duration, when you look at the debt servicing costs, has actually collapsed just because they stayed in their homes longer and their wages kept on rising during an inflationary period. Their wages increased more, and then everyone kind of refinanced to kind of sub 4% mortgage rates. Now people sell their low mortgage rates every single week. You're selling that low mortgage rate to buy something at 7. Okay, you're probably doing very well off. But the housing stock itself, excluding the 40% that do not have any mortgage debt, the percentage of disposable incomes for them are at historic lows. That data line will change over time. If you have a 7-year duration of higher rates, then that goes lower. But the stock of home owners is at a historical level. So they actually have an advantage where renters don't. So
Right.
that's
Okay.
why we see the stress in the auto loan delinquencies, the credit card delinquencies tend to be renters because their total wages are much lower. A lot of them are single households, right? So they don't have the dual household income. The net asset values that they have, let's say $52 trillion of home values, they don't have any of that in the terms
Yeah,
as
but Logan,
leverage.
we looked at income, and we saw that family income it was low, and I still, I hear your point, but you still can't convince me that people are better off now. I mean, 30 to 40
And I'm saying
purchasing,
that the
Logan,
homeowner income
30 to
is
40
higher than
percent
that.
purchasing power lost. So if you're a homeowner, you want to sell, right? Let's say you're getting divorced, whatever the reason is, you can't sell. They're not
Well,
better off. The
we
rates
do
are
have
higher.
sellers
They were saving at a rate
yeah.
of double. In
So
2019,
in
they
a
could
sense,
save at a rate of double, Logan. The PE ratio was 20. The payment to
so in a
ratio
sense,
was
the
lower.
homeowner that's
Unemployment,
staying
Logan,
in,
was 3.6. They were getting income growth in
yeah, but the
2019.
homeowner that
They're
stayed in
doing
their house,
quantitative tightening, Logan. They're doing
that
quantitative tightening.
the homeowner that's in that house doesn't have that disadvantage because their incomes have risen. So their
But
net housing costs.
but what data is showing income has risen for those homeowners? Do we have
But
a data
wages
set?
rise every single year. They've stayed in their homes for a very long time. So this is
But
why you have to
where's the
look at the
data?
mortgage.
Do we have a data set?
Yeah, you go if you go look at Fred, go look at mortgage payments as a percentage of disposable income. It goes all the way back to the 1980s. So this is like 14 years of data of rates actually going lower and people living in their homes longer and wages rising. So this is the homeowner set income, right? So this is just the people that actually own homes. So
So
if you look at that,
don't look at Fred. Don't look at
go
Fred.
yeah
You're saying.
yeah go if you go look at Fred, that paints a different picture. Just because rates have fallen and people have refinanced and their wages have risen. So it's a historical event. You could actually see it happen. We deleveraged so much debt from 2010 all the way down to 2017 through foreclosures, bankruptcies, and short sales. So the foreclosures, bankruptcy, short sale data is actually still near record lows. You would actually need to have like an authentic job loss recession
Yeah.
to actually see
Right.
that net increase. But
Which we
then,
haven't had yet.
yeah,
And I hear a lot of people talk about this is what we need comparing 2008. I hate when people compare 2008 because in 2008 we're in recession, and the bad stuff doesn't happen till recession.
yeah.
So we
The
can't
thing
really
about
compare what's going on right now, being we're not in a technical recession, to 2008. Because during recession, foreclosures go up, credit tightening happens, right? People stop spending, people start saving. I'm running us late. I'm so sorry, dude. I'm so sorry.
actually to address your point, why 2008 is a bad comp. So this is bankruptcy data. This is foreclosure data. People were filing for foreclosures and bankruptcies in 2005, 6, 7, 8. Then the job loss recession happened. So credit was deteriorating years before the recession happened. So this is the New York Fed data. This is all those exotic loan debt structures the 2005 bankruptcy reform laws were enacted here. So everybody filed for bankruptcies before the law happened. And then the mortgage credit crisis happened. Then the job loss recession happened right here. And after a qualified mortgage, this data line has been trending lower. Just because if you look at it, the 2005 bankruptcy reform laws and the 2010 qualified mortgage laws were actually a really big deal. It changed the consumer profiles for homeowners because they're not allowed to leverage credit up like they used to in the past.
All right.
This
well,
is why
to go to your point, though, again, to go to your point, here's homeowners we're looking at. Okay, this is delinquency rate of mortgages originated within the last 6 months. And as I think you were a branch manager, you know, as a branch, how bad an early default is for a branch or even a refinance within the first year or 6 months. We get our SRP taken back depending on your level of branch, how you're managing your branch. But Logan, again, what I wanted to point out is the trajectory is there. The trajectory is going up for bankruptcy. The trajectory is specifically for 6 months, the recent homeowners, it's all going up. We're at 2010 levels. And that includes conventional, that includes FHA, right? Conventional mortgages. It includes FHA and includes VA. And the conventional is hard for you. I'm sorry, brother. It's hard to see. Conventional is right here. It's like the little gray line. And basically I've highlighted right here. Conventional's this is 6 months. Conventional's at 2010 levels. So the trajectory is going up of delinquency. Again, for this category of homeowner, the 6 months before.
30, 60, 90, and 120-day lates are still near all-time lows. That will, in fact.
Look, I'm talking about the trajectory, though. I'm talking about the trajectory. And this trajectory for the 6 months originated, we're looking at this is from Black Knight. It's going back to 2010 levels. Can you acknowledge the trajectory at least? That's
like under 1%, isn't it?
My point is the comparison, and my point is the trajectory, right?
Yeah.
If it's going to stay flat, if you're saying things are going to stay flat, people are making more money, people are better off than 2019. Well, the delinquency rates are now higher than 2019. How's it possible that people are at better shape 2019 if all of delinquencies of new category of debt is accelerated?
No, the 30, 60, 90-day lates are still trending near all-time lows. So that's the FHA and VA loans are different, of course, financial backgrounds, but the conventional loans or the total stock of mortgages out there are still near record lows. In fact, that's the one thing I thought would catch up faster. That hasn't happened. I thought we would get to pre-COVID levels a little bit sooner. We haven't done that yet. So that's another thing that I got wrong. I thought the delinquency ratios would actually come back to pre-COVID trends.
Those moratoriums were brutal, dude.
Yeah, well, for forbearance, and the equity is down to like 0.22% of all loans out there now. So
really, right, but that's just for the COVID. That's last I looked, 325,000 families. If we look at the foreclosure inventory once we hit the GFC, I think what was the total foreclosure sales? 1 million for the 4-year period. So if we had a 325,000 families and foreclosed on, not that I'm saying it will, but they have been in forbearance for 4 years. They've been kicking the can down the road for 4 years. No one's talking about that 325,000 people. No one. Do you ever look at that data?
1 to 3% of all loans are technically in a foreclosure process always. So that's
okay.
That's
so
the norm.
Do you look at the data of that 325,000 families that are still stuck in that? And what's crazy, Logan? Those people may have been in forbearance before COVID. It's just like they got the free ride, man, and they're trying to. Did you look at that data?
I think that's like 0.1% of the total composite of loans out there.
Okay, all right. Let's move on to the next projection, inventory. We're talking a lot of stuff. Thank you so much, Logan. I know we're kind of a little bit all over. Hopefully the viewers are getting value here. I really appreciate the back and forth, man. Having fun. Talk about inventory, brother. What do you see happening with inventory 2024?
So far, this is another thing I've gotten wrong. I thought inventory would grow a little bit faster, and my work is a little bit different because I have the weekly tracker, especially with rates getting above 7.25%. I thought we would get more 11,000 to 17,000 prints. People that are familiar with my work, that was a big whiff I had last year when mortgage rates were heading toward 8%. I never got it one time. So this year so far, because I'm not a mortgage rate lockdown person, because I believe higher rates inventory can grow, it hasn't grown as fast as I thought. And the new listings data, which I've been pushing is going to grow this year, has been slightly lower than I had anticipated, and we're almost at the seasonal time. I was hoping. I thought 100% we'll get at least an 80,000 print on the new listings data this year. Traditionally, pre-COVID, we're about 95 to 110,000 would be the seasonal peak, and it looks like we've already had the seasonal peak. So on the inventory side, I've been incorrect in terms of the growth rate. It's been a little bit slower than I thought. Now we have the second half of the year, and really depends on where rates go. Mortgage spreads are actually better this year. This is another thing I got wrong. I thought the spreads might improve the closer we get to an authentic rate cut, but they've improved also. So that's just to give everyone an example, rates would be 0.5% higher today if the spreads were using the worst levels of last year. So on the inventory side, I still think it's the best story in America in housing, that inventory is growing, but it's still a little bit slower than what I had anticipated. But again, we have the second half of the year to work with.
So what was the number? I'm sorry, did you give us a number?
I just look at I just look at weekly numbers on,
so no
on
number.
11 to 17.
So no,
yeah,
did you
11 to 17,000 on a weekly basis, and we've only had that 2 times this year. I was anticipating at least 12 to 13 weeks of that happening out there. So if you want to take the NAR data, it would actually take us closer to about 1.52, 1.53 if that's demand, if that inventory curve worked. So far, we're at 1.21, and that's so far that inventory growth has been slower than I thought it would be this year.
Okay, thank you, brother. So just to reiterate, I don't want to put words in your mouth. Right about this year, right about 1.5 million.
We would get up to about 1.5 on the seasonal peak. Okay, that's a lot. I know that's a lot, but I had
that's a lot. That's good. I like that. I like that.
No, but I mean that gets us back to the bottom end range of the 4-decade level, back to 1982.
Okay, so what about the last 20 years? What is what's the average
inventory? So when we look at if people want to look at the NAR data, the traditional active listings are between 2 to 2.5 million.
Two and a half, you said?
2 to 2.5 million is the traditional normal level. So that would be normal going back to 1982. 2007 was 4 million. We got to under a million COVID. If we get to 1.52 to 1.93 and we get 4 months supply, there's your balance market. That's historically low, but I'm not a 6-month supply.
So say that one word. You said 4.2.
1.52 to 1.93 and 4 months supply gives you a balance market.
Gives us a balanced market, right?
Yeah.
I mean, that's well said. So let me pull this up just to show the viewers. Now, what he was talking about was, the 2.5. First of all, we haven't had 2.5 as far as year end. When we look at this, is from NAR, National Association of Realtors. Logan, we haven't even had 2.5 million homes since 2010. In 2011, we hit the 2 million mark. But I'm saying that because over the last 10 years, if we just look over the last decade, the average has been more like 1.5, 1.6. So
we were trending, we were trending lower and lower. This is my whole credit market.
Right. No, but my point is telling people that we didn't come from 2.5 million. Looking at the last 10 years, it was more like 1.6, 1.7.
Yeah.
It wasn't until we get back into the GFC years that we have that. And even when I go back to 1999 was 1.7, 2000 was 0.8. And then we finally got to 2 million in 2022. But basically there was 4 years of.
So this is for your viewers. This is the NAR chart of inventory. Okay, so after 2010, when the qualified mortgage, we've been slowly moving lower and lower and lower. So just getting back to here to me would be normal, right?
To 2010,
abnormal. Yeah, this is if you look at this period, we had a lot of active inventory, right? Back then, but as first-time home buyers started to buy more and more homes, this inventory channel kept on going lower and lower and lower, and then it broke post-COVID. It was about to break anyway, but it got pretty bad during the COVID-19. So just getting back up to 1.52 million would be okay. Okay, so that's why I use that number. That number is lower than the historical average of 2 million, 2 to 2.5 million. So 1.52 million is kind of like my target level. That's why I use that. rather than the 2 to 2.5 million that people have used before.
Right. But just to clarify, I think I may have misunderstood. Did you say the normal is 2010 levels? Did you say that?
No, the historical norms from 1982 to pre-COVID is like 2 to 2.5 million. My argument is that 1.52 to 1.93 would be normal now, especially when you got 4 months of supply.
Yeah, exactly. Yeah, I would. That's exactly my point. And now I forecast I'm going to stick with it. You're actually more aggressive, Logan, with your inventory than I am. I don't like to look at like total active. I like to look at like active minus pending, like what's available like right now. And I think we're going to get to 1 million, but total, I'm thinking 1.3. I don't think we hit the historical 10-year, which is about 1.516 until 2025. But I'm a little bit under you as far as inventory growth. Now, I would certainly love to see it, but again, if inventory is going up, then we know that demand is not keeping pace, which would create more pressure on prices to go down.
So
is that correct?
I think everybody has different inventory channels. Like our Altos data, the total active inventory level is 570,000 right now. So that's different than the NAR's data. Our data line is.
Could you explain the difference? Why is that so low? Why are you? Oh, single SFR only.
Our Altos data is just homes available for sale. The NAR data is all the homes that are pending in contracts and condos and everything. So it's naturally going to be higher. Our new listings data is the homes that come on market that don't have a contract, right? That's traditionally the seasonality peaks are usually like 80,000 to 110,000 pre-COVID after 2012. We haven't been able to break above 90,000 for the last 4 years. This year, the new listings data has been a little bit slower than I thought it would be. And we're almost at the seasonal peak right now. So we have probably about 3 or 4 more weeks of that before we see the seasonal decline. So the inventory growth rate, it's actually 2024 actually looks like kind of like a normal year.
But you know what's interesting though, Logan, is we didn't have seasonal decline the last couple of years. Actually, inventory went up towards the end, breaking the normal seasonality. Now, do you find it interesting also, Logan, that we already have 3 states that have over pre-pandemic levels of inventory? We have Texas, we have Florida, and we have Arizona. Do you find that interesting? And does that change any of your projections?
So you froze, but I heard Florida. So I will tell you this. If you
wait, I'll say it again. So Logan, so we have 3 states. The last I looked, this is Fred. We have 3 states that have over now pre-pandemic, and the inventory has been skyrocketing. We have Texas, Florida, and Arizona. Is that massive increase of inventory? And will that ever affect your pricing or any of your projections?
Any parts of the country that is at 2019 inventory levels that have negative demand curves are at pricing risk.
Okay.
That's been my baseline case since 2022. We just have to get back to those levels. So if you look back what happened in 2018 and 19, real home prices actually went slightly negative just for like a month back then.
2019?
That's with the inventory levels being as low as they were. So
Logan, you're saying 2019?
That's where the affordability.
Logan, did you say
affordability matters? 2019? But that gets you any places that are 2019 inventories are in play for that.
You know what? Thank you for saying that. See, I know you're watching the data, bro, because I remember 2019 and I had an emergency meeting with my spouse, Logan, in 2019. I'm like, the industry is slowing down. We got to rebudget. So my wife and I rebudgeted all of our finances, and then we went into COVID and like the opposite happened. And that's why we were able to save money, because we were prepared for a downturn, and then the opposite happened. And I was killing it with the refinances, man. I was taking my old customers with the 4 and 5%. We're getting them to 2%. But I appreciate it. Let's move on to the last thing. My God, it's an hour and 13 minutes. How have we been talking this long, man? Mortgage rates, last projection, and then I just want to end on maybe some last points you want to make. But tell us your thoughts on, and I know we could talk about the 10-year, but let's just specify. Let's dumb this down to residential mortgage rates, because that's what the viewers really want to know. What do you see happening with mortgage rates in 2024?
Oh, so you're frozen on my end.
Oh man, am I frozen?
So I just get little glimpses.
Mortgage rates, 2024.
I'm almost at my time limit, but I don't know if you could hear me or not.
I can.
Just wanted to say thank you for this opportunity. And it was a lot of fun and a good conversation, right? I think that's the good thing, is that conversation talks about different models and different things, because that's how a marketplace works, right? Everybody will have a different kind of take on that. And it was a lot of fun. So thank you for having me.
Logan, appreciate you coming here. Hopefully we could do it again soon.
Definitely.
All right, see you later, bro. All right, guys. So there we have it. There's my debate. I hope you guys see what I'm trying to do. First live, okay, hit 100,000 subscribers. First live debate with one of the top housing market bulls. I do it because I love you. Same thing with Joe. You guys, we got to 100,000 subscribers and I interviewed Joe, a bull. The reason I'm doing that, again, I want you guys to understand, is I love you. We can listen to other people. I don't want us to get stuck in some echo chamber. We need to hear all aspects of what's going on. And unfortunately, Logan had to go. He couldn't really project his mortgage interest rates. And I was hoping he would be able to just end on some points. But where I want to end that debate on some points, you guys, is, again, we have payment shock. We have payment shock happening around the nation. Payment shock is hurting the recent homeowners post-quantitative tightening, renters, and it's even hurting the pre-quantitative tightening homeowners in the form of property taxes, Jeff, homeowners insurance, and this is a big one, guys, you're not considering, new debt. The data tells us people are getting into more new debt. And then in addition, I hope you guys took away that we do, despite what people are saying, the data suggests that we have a lack of real income growth both in the household and the family. The difference in the two, a household income is when you include everyone in the household. Family income is only family. And then also, guys, to his point, Logan was saying the market's going to remain flat. Well, if the market remains flat, then inventory can't go up. Inventory has to stay the same and demand has to stay the same, but yet inventory has been going up. We have now 3 states. He said it himself, price risk. But really, you guys, the 30-year historical affordability average, I think, and I wish we would have talked about this a little bit more, but when we look at the historical averages of what we need to go, I think it's a high probability that some event happens that creates a nominal deflation in house prices. I think that is the most logical way to get back to normal affordability. But give it up for Logan. He came on a live, that was good. I want to round us out real quick, you guys, on new home data. So we're going to finish this out. Let me make a quick timestamp on new home data, and then I'll get you guys out of here, and happy Friday. Let me know how we did. Let me know if you guys enjoyed the debate. But I wanted to show you this real quick, you guys. Boom, boom. I think I'm good right here like this. Okay, so we're going to go into new homes. So new home data came out, you guys. And I wanted to start here with hold on, let me switch my camera. Permits. Okay, so permits right here is down. It went down pretty sharply. I'll do a separate video, but we're sitting at 1.4 months now. I want to get through this quickly to let you guys go. Total units, previously, this is started. So started actually did go up. Units actually did go up month over month. Let's look at the next thing. Under construction is barely going down. So we still have 1.6 million units under construction, you guys. That is huge. Median sales price right here, you guys, did go down. I mean, this is crazy. I think there's going to be revisions here. But really what I wanted to point out as well, and I wish that Logan didn't have to go because I wanted to bring this to his attention. Right now, we have more months of supply than 2009. We have more months of supply for new homes, sitting at 9.1 months. You guys, come on. 9.1 new construction leads. We have 9.1 months now of supply with new homes. That is the highest level. Okay, let's see here. That's the highest level since May of 2010. Do y'all know that? We're near GFC levels of actual supply of new homes. And I think that's data worth considering. All right, you guys, other than that, again, just, it's hard work doing these things. We do these lives especially for you guys. I don't make money on these lives. I prepare a lot, and it's a little bit stressful sometimes, but I appreciate you for the shout out, man. A realtor named Adam, big time interview, Trav. Thank you. I wasn't trying to bash Logan. I really I wanted to show you guys that I can debate, even though I've never debated before. And I also wanted you guys to know that I'm choosing to be nice to these guests, even though I don't agree with them. The interview with Joe, I mean, come on, guys. I mean, you see that I think I can debate. I don't know. Let me know how you guys feel. Happy Friday, you guys. Don't get drunk. Don't go out to eat. Go take a walk. Go enjoy your family. And in fact, you know what? I challenge you. Go rebudget right now as soon as you stop listening to this. And other than that, guys, I really appreciate you joining us. I appreciate you guys letting me go back and forth. And if you're out there investing in real estate, you guys already know that I wish you luck. And I do, I really do hope you